Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Trader Ferg. Ferg, how are you today?
Good, thank you, Robert. Thank you for having me on. Pleasure to be here.
Yeah, really looking forward to this because I really enjoy your writings as well. And I thought a very good place to start would be a 30,000 foot view of what you see going on at the moment. And you can approach that from an oil point of view, natural gas, or just major indices, however you want to start. What are you seeing happening at the moment in the world?
Yeah. So the really high level view, and this is what I've been pretty much beating the drum on for pretty much the last 5 years, I guess, was I just saw the fact that there was a lot of capital being kept out of commodities at the same time when you kind of did the sums on the US in particular's financial situation, it was always going to end in inflation. They have no way, even with all this Doge efficiency, when you actually look through what they can actually cut and what they've pretty much said they won't touch, the likes of entitlements, the likes of they can cut a little bit of defense. I see Trump's now saying that he'll reduce it a bit year on year.
Hmm.
But yeah, the entitlements, Medicare, they and the sort of just the interest, it's I think was it 87% of it is non-discretionary. So they're going to print their way out of it in the end. And that just provides a bit of a tailwind for what I already see. Like it's not kind of the base case. I'm not that much of a high level macro guy. I like to just dive into industries, say why are they bottom crawling when I know they're cyclical and what's going to cause that to inflect. And so when I have that sort of a backdrop and then go in and look at a whole lot of different commodities and say, yeah, this supply demand, um, this is going to cause higher prices, all things equal, because the supply isn't there and demand is holding up. Like coal's a great example. It's just the idea was it was in terminal decline, then we were going to be off it, yet it's setting a new high every year. Um, Oil is not far behind it with the idea that we were going to, like you can go back to 2020 and see all the headlines of peak oil, and you just can do the numbers and see the decline rates, like Exxon's latest presentation. It's pegging the annual decline rates at 15% per annum if investment stops, which is pretty incredible when you consider historically it's been 4 to 5%. Obviously, fracking of shales having a big impact on that. And yeah, just go across the commodity complex and I'm trying to find like a narrative that doesn't make sense, like something that's I always use the example, the one that always stood out to me the most was like recently we've had the narrative of we're all going to be driving electric vehicles. And so as a result, we won't need exhaust systems. And so you won't need the catalytic converter. And so the demand for PGMs will be in decline. Whereas on the other side, what I think was over forecast would be the need for lithium. And so when you see scenarios like that, you can try and dial it down to sort of a trade idea and a way to play it that's got big upside that the masses haven't really clicked onto yet. And that's pretty much what I spend all my time doing, is trying to find the best way to execute those ideas.
And that's a great thing to do. And I would like to deep dive into some of those ideas a bit later on without doing a disservice to your paid subscribers. I appreciate, there's going to be a lot of information to go through. That actually reminds me of a chat I was having recently with Dave Collum, and we got on the subject of platinum because I can't remember how we got on the subject of platinum, probably talking about gold and silver. And he mentioned a little while ago that platinum, there's something about it. He said that some very high level smart people were talking to him about it, and that prompted me to have a quick look at a price chart. And I'm not a one for all these Kelter channels and over analyzing that. But I took one look at that chart and went, that's a bit strange. That doesn't look quite right. Or if something goes right, that could break out in a big way. So I'm considering taking a personal physical position in platinum just because. Then he was going through some examples of catalytic converters and other things that don't spring to my mind. I guess what I'm trying to say, because I'm rambling, I guess what I'm trying to say is, number one, is platinum on your radar? And if not, is it that level of general thinking that's helping you identify opportunities?
Yeah, no, platinum's certainly on my radar, and so that's it's a decent percentage of my portfolio now. So anyway you come at platinum, it's dirt cheap. So a lot of people are ratio based, and just looking at the ratios, it's ridiculously cheap versus pretty much all the metals, especially versus gold. It's at pretty historic low ratio, so that should make you bullish. The first place, then you've got the as you mentioned, you got the catalytic converter angle, that it's actually more of it's required since 2020. There was a sort of an innovation that allowed you to replace a certain amount of palladium with platinum in exhaust systems, and so they changed the ratio slightly, so that increased demand for platinum. And the interesting thing with it really is you're getting an angle in a physical metal that's record cheap, and the production profile for it looking forward is the vast majority of it comes out of South Africa, and they're having a lot of issues there. So the Bushveld is kind of like a reef that wraps around the bottom of South Africa, and that's got the highest platinum deposits, and they've been mining it for a long time, and they've worked through kind of like high grading. They've worked through the majority of the good stuff, and with the prices being in the toilet, there's no real investment moving forward. And so if you look at the whole PGM space, there is quite a few projects that can bring more on, but they're the palladium rich, far higher in palladium and lower in platinum. And those projects are in Russia with nickel, and that's largely a byproduct. So it's a byproduct of their nickel production. So it's not actually their main focus. And if anything, they've got an interesting dynamic there, where since they're so focused on nickel, they're obviously pushing the battery angle more, and their projections for PGMs are a bit more on the bearish side. And I believe their biggest expansion has been pushed out 2 years now. And so if you look at some of the growth in what could happen across the PGM space, it's actually been pushed out. So that impacts supply, especially with the South African supply really starting to roll over post 2030. Becomes quite a gradual decline there. And the other one which can move the needle is Zimbabwe, but it's just, it's palladium rich, so not that higher of platinum. And I love the trade. The problem with the trade is you generally have to apply it via some pretty undesirable miners. You have to go into South Africa. You have all the geopolitical risk. You also have some of them quite high cost. So the likes of Sibanye is underwater on current PGM prices, platinum, palladium, and so you've got silliness out of the South African government. They've just approved what is essentially a step in the wrong direction with a ability to expropriate land or property, and so that's not nice to see. When you was hoping that wouldn't happen with the likes of Democratic Alliance being involved in the coalition, but they said they'd walk out if it happened, and they haven't, and it has happened. So that's a bit disappointing. But overall, I think it's highly asymmetric. I going with more the rhodium angle because it's a byproduct of largely of platinum. That you can get a certain amount from the palladium deposits, but it's far lower. It's in the 1 to 2%, whereas pretty much the vast majority, you're talking like 85% of rhodium production comes out of South Africa, and in particular out of Bushveld. And that's all from these platinum rich deposits, which get up to 7-8% and even 9% in some of the splits. And so I kind of found that angle fascinating, and I went with physical rhodium, which is pretty much the most cyclical commodities I've come across. It seems to do a 3 to a 5 bagger every 5 to 10 years. And yeah, I can go right down the whole demand side if you want, but yeah, I'll stop rambling for a second.
No, I say let's go down the rabbit hole. I think this is all about adding value, and I know that there's people that are listening to this. Gold, silver, the main things, platinum possibly on the radar, but then there will be people that want to know more about geopolitical risks and stock. When I say stocks, I mean stocks related to PGMs in this case. So no, feel free. You have the floor, Ferg. Please do go down that rabbit hole.
Yeah. Okay. Well, so the demand side, I think so I wrote a piece called the new energy vehicles pivot, which was the idea you've always got to be on the lookout when a big narrative pivots. And this was the one that, similar to the idea of global warming to climate change, like it was a pivot because they sort of, once you put a broader sort of scope, you can stick with a narrative and you don't have to get called out. Like with climate change, they can point to like any variable in the climate can now fall under that. And I see the same happening with EVs. They've now realized that the adoption rate for EVs isn't keeping up with the trajectory that the likes of the IEA had said. And what's actually happening, if you look at the data closely, is that plug-in hybrids are really starting to be the winners. And the way to frame this is China has, since its property bubbles rolled over, it's been absolutely throwing all the it's really tried to kick off its industrial side industry. And so it's opened the floodgates for all the credit and loans that they want, and sort of created a ton of competition within each sector. And we're seeing this. If you pay close attention to China, the amount of innovation and that each champion from each industry is just coming out so competitive, like within the EV space. I think they started with, I think at height was 230 EV companies, and they're down to like 120 now. And BYD is absolutely slaughtering, not only within China, but across the globe. So even I went down to Uluwatu, down the bottom of the island here for Valentine's Day, and I hadn't seen a BYD car until we drove down there, and I sitting in traffic. There was one point I saw 20 in a row, and they're just this is all, yeah, I hadn't seen one 6 months ago, and now they're just popping up everywhere. And so what I see is happening is they know that the competition is cutthroat. China, unlike the West, they subsidize a lot, and then the state entities put out a lot of orders to help get the companies on their feet, and then they pull it all back. And so now China's in the process of pretty much removing the subsidies and saying you're on your own. And so BYD has, I think, understood that the demand for BEVs, like battery electric vehicles, isn't there. A lot of it was kind of where it was the early adopters, where it was Western countries where they had the charging infrastructure. But there's a point at which it just doesn't make sense, especially in the developing world, where the vast majority of people don't have the ability. For starters, they don't have parking. They need to park on the street. And even if they do have parking, you've only got the standard wall plug, which doesn't charge an EV. So a plug-in hybrid makes a lot more sense. And I've been tracking BYD's numbers because they're just the most competitive. Like you see it, I call it like the Apple moment, where we all used to wait for the next iPhone to come out and you just be fascinated by it. BYD's had that with its some of its releases. Its Seal can do 2,100 Ks on a charge and a tank of gas. Its latest four-wheel drive can float, and it can do a 360 on the spot and park completely parallel into parks. It's just innovating, and the seal only costs $14,000. So it's that point at which, like, what can even compete with that? And I just see this, they're taking over market share in China, and they're also going to take over market share where all the brokers, which can be in the developing world, for first time buyers, like at that price level, a lot of people can afford to buy their first car now. And so where I'm going with all of this is a plug-in hybrid, because you have the battery electric engine and you have the ICE engine. Starters, the battery is only 1/3 of the size of what it would have been in a full battery electric vehicle, because you've taken away the range concern with still having the ICE engine, and you've now got to switch back and forward between the battery and the ICE engine. And so that point at which you start up an engine is the maximum emissions. So with a plug-in hybrid, you actually have to have a higher loading of catalytic converters, and this is a big demand driver for PGMs. And yeah, and so that's what I think people are starting to click onto. But if you look into BYD production and sales numbers, their 2024 right up till December, their numbers, their plug-in hybrids were up nearly 80% year on year, where their battery electric vehicles were 8% up, and they're now producing 58% plug-in hybrids, and the straight battery electric keeps dropping. And so I think that's the future. And I think the way you play this is just playing that underinvestment in PGMs and going with the most sort of asymmetric play, which I think's just physical rhodium, because you also get a play on the miners in South Africa having geopolitical risk, having sort of all the, like, just the, I follow a expert, Dr. Davis. Unfortunately, he's passed away now, but he was estimating with all the load shedding in South Africa, that was going to reduce South African PGM production between 15 and 20% per annum. And so there's just so many headwinds in South Africa for producing PGMs, not to mention that it's just under the cost curve. So you've got the likes of Sibanye that it's got an operation in Montana. It's put it into care and maintenance, which kind of, that's just almost rhymes with the likes of a lot of the uranium projects will put into care and maintenance, and then the price rips and makes it economic again. So yeah, that's a quick dive down that rabbit hole.
Again, I really appreciate that. But should just make an apology. Though I've not been speaking that much, I've just realised my microphone's been pointing in the wrong direction, which is a completely rookie error. So apologise if I've not been coming across quite clearly. I will point out, Ferg, you've come across as clear as anything. So apologies on my end if I've not come across that clearly on the podcast recording. Going back to PGMs, and so I think that's a really good way to look at things. And that's what I really enjoy about your work is taking a step back, looking at these sorts of bigger trends, and then going, right, okay, well, let's try and put two and two together to make four, like it should be. I think that leads me on to, we were saying off air briefly, to, the widow maker that is natural gas would be a nice one to have a look at, because I've seen varying degrees of not success, but I've seen people say one thing and then people say the complete opposite. So it'd be good to get your thoughts on that. And then also crude oil as well. So which one of those would you like to attack first?
I think I'll attack crude, and then I can tail it into gas, because I think it is one leads to, and you've got the likes of fracking. I think oil's probably the most interesting risk reward set up at the moment, because it's pretty much been the most hated. I was kind of fascinated. We're back at this point after, like, the lead into 2020 and COVID. There was this point at which everyone was sort of cheering for ESG,
Mm-hmm.
and what I always kind of figured it was ESG was a lot of the funds tagged ESG were just tech and drag, and what you essentially got with ESG was just filling a basket full of tech stocks that were created low emissions and had better environmental standards, because they don't actually have to do any real world sort of heavy industry, and dropped out all the energy stocks, and it was kind of the perfect trade to have going into 2020, and that's why they outperformed. That's why everyone sort of loved the ESG. It was because they got great outperformance, and they got to feel good about having like the ESG side essentially for free, which is just an add-on. And now we've kind of, while ESG's died, we're again at this point at which energy's been absolutely punished, and tech got kind of a second got a shot of adrenaline in the arm with the whole AI boom. And feel like that's kind of starting to lose momentum. Like the craziest of it, like the meme coins and all the craziness there, is that's kind of been sucking a lot of capital out of honestly almost everything. I kind of subscribe to the point that like the likes of X7 and in particular like Nvidia, that's just been an absolute capital vacuum. And coming across to oil, it's interesting because the narrative that seems to be really consensus is the sort of EIA's fact that there's almost like they push the glut, but they're always kind of been a bit sort of they've always pushed the renewables narrative a bit much, and so I think people understand that they're a bit too much on one side of the boat, but that at the very least there's a lot of spare capacity with OPEC, and that you're just going to see nothing out of oil, and that the shale, particularly the Permian, is going to keep plugging any requirements on the demand side, like it has essentially the last decade. The shales have plugged pretty much 95% of all additional demand growth. And when you look what's happened more recently is the fact that it's really stalled out, and it's stalled out for a while now. It's stalled out for over a year. Haven't added really any incremental growth across the whole shales, but in particular the one that's got everyone's focus is the Permian. And when you look behind the scenes there, and there's multiple ways you can do this. Like you can bring up the reserve reports and see are they actually growing production, or is it just becoming gassier, which kind of means they're getting more mature. And you can see this with the likes of Pioneer, which Exxon acquired. If you bring up their reserve report, you can see the crude's actually rolled over. I think it's down 8%, whereas the gas and the NGLs are still really in the positive, which means, so similar to you've seen Chevron say, they're really dialing back capex, and pretty sure they're seeing the same thing. Is that they've got a set amount of like kind of tier one acreage left, and if they just throw more money, they're going to work through that quickly, and they're going to be onto the tier two, and then they're going to have a rough time keeping up production. And this is, I think, the best explanation I've seen for this, or the best parallel, was in Go Rosen's work. They went back to the 80s, and kind of once you see this chart that efficiency and rig count kind of mirror each other, it all makes sense in the fact that there's been so much happy clapping about the increase in sort of fracking efficiency, but it's been with a decreasing rig count recently, and that's just every rig that gets taken off, it's obviously going to be the least efficient rigs will go first, and so you're just focusing more and more on a lower and lower rig count that's got a higher and higher efficiency. You don't find out where things really stand until start trying to lift that rig count when you've worked through once you've essentially high graded all the good stuff. And that's where I think we are now. I think the sort of common, the consensus idea that if prices move up at all, that shale will just patch that hole is completely wrong. And if you kind of separate the oil space into three, like you've got the demand, and consensus is everyone's revised demand up. Demand's reasonably strong. Everyone's coming in around that 4 million barrels a day. Even EIA's revised their demand up. You got inventories at the bottom end, pretty damn tight. And so the only real factor that everyone's thinking is going to show up is on the supply side. And if you're really paying attention, I think it's not showing up, then people are going to be surprised how quickly OPEC's spare capacity is going to be worked through. And with all the talk of Trump's sort of drill baby drill 2.0, yeah, he can get a few regulations out, but you can just read all the headlines from the oil majors. They're not suddenly splashing around capital to get things, and I don't think they can. Just as I mentioned, I think they've gone through the all the tier one stuff and the tier one sort of resources in their portfolios. They're going to maintain it and try and produce it quite conservatively. And so when you put all that together, I love this setup for oil. I love it when everyone's on one side of the boat and sort of expects nothing from it. And I think it's going to perform really well over a sort of a 3 to 5 year time frame. Granted, been pretty beaten up the last 6 months on a lot of the trades.
Yeah, so I was going to say before we go on to nat gas. Now I'm not asking for a price prediction from you because I appreciate everyone's different. Do you think that again? I think the consensus would be from most people is that there's going to be some form of economic correction this year. Now that might not be a full-on blown recession. It could just be a regular correction, and then the rest of the year could be okay. So where I'm going with that is if there is a bit of a correction and then we take off again, if you're looking to do something with oil, would you wait for that correction, or are you saying, hang on a minute, all these fundamentals are here, it doesn't really matter. Okay, we might take one step back, but we could be going 5 steps forwards here. How would you approach that for anyone listening, thinking about trying to trade oil or get a position in oil?
Yeah, so never say never. There could definitely be a big correction, but I just think all the stuff's cheap enough. I've loaded the boat with it and really positioned heavily in December, and it was just all cheap enough for me. Hey, maybe it gets cheaper, but I've learned lots of times if you see something really cheap, you should just sort of take the position in and be prepared to weather a bit of volatility and not be too smart, because once the stuff starts to re-rate, it can re-rate quite quickly. And the main place I was positioning was in a lot of sort of offshore drillers, offshore like OSVs, service companies, and they all just looked absolute dirt cheap. I think they're all getting dumped on the back of tax loss selling. They were the obvious target when everyone was looking for something to harvest. And when you looked at the assumptions that were going into their valuations moving forward, that they literally have sort of contract books. You can look out how much backlog they've got, so you can work out what they're actually going to own. And it was stupid cheap. And so maybe it's cheaper, but I think it's massive margin of safety and cheap enough. So I'm prepared to sort of weather any volatility moving forward. And I think any volatility in the oil space at these levels will be relatively short-lived. There's a sure, price can jump everywhere, but if you kind of looked at history as well, I think a lot of the sort of demand destruction's quite overblown. Like just rattle off like in in the global financial crisis, oil demand was only down 2.5%, 3% year on year. And COVID and the lockdowns, where there was consensus that oil demand was going to take sort of a 30% hit, ended up being 8.5%, 9% year on year. And that was locking everyone in their homes, shutting down global jet travel. And there's this interesting dynamic as well, that if you actually do have say we go with like a really bearish outcome and you absolutely smash oil, you get it to 50, you get it to 45, you're going to absolutely put the brakes on all the US sort of shale production. They're all they're no longer using debt to fund it. They're if they go under their sort of under that cost curve, they're going to dial back capex. They want to keep their free cash flow. That's what they're being sort of rewarded for by shareholders. So you're going to see, and with shale, like it's a pretty immediate dial back on production if you dial back capex. And likewise, when you look through history, like lower oil prices are stimulative, and so developing world will consume more. And then you can see this again and again, like oil demand bounces back pretty rapidly to sort of its long-term trend line, which is long-term trend lines is growth year in, year out is between sort of 1.2 and 1.4% per year. And you can almost, you take a line and draw that right back to like the 70s, and it's almost like a straight ruler. And every time it diverges from that, it gets back to it within a year or two. And so could certainly be wrong on a sort of a year basis, but if you take a sort of 3 to 5 year view, I think the risk reward's amazing. And especially as well with some of these companies, you've had restructurings, bankruptcies, you've had a whole lot of debt written off, your net cash now. A lot of people I respect are sort of coming at it from different angles. I obviously like the offshore angle. There's a group that loves the Canadian oil producers. I think they'll do amazing as well. There's lots of different ways to come at it, but it's just where your circle of competence is. And that circle of competence is really important because you need to understand what you own so that you can stomach the volatility that's inevitable when you're in these commodities. There's one thing that's certain is you always have gut churning volatility in commodities.
Yeah, that is so true. Without a shadow of a doubt, it reminds me of had a Don DeVette on recently, and he was talking about gold miners, silver miners, and he basically got to the conclusion, or his conclusion was that if your belief in the gold and silver space is that gold and silver ultimately is going to go much higher in the next 3 to 5 years, maybe even longer than that. If that's your belief that they're going to go higher, then chances are you're going to do well. Now, of course, there's a lot of companies to look at. You obviously got your majors, your miners, your explorers, all of those sorts of things. So it's not like pick a gold company, here we go, I'm going to win. Nothing like that. But I think the point I'm trying to get to there is that he said that if your belief is that's going to go in that direction, then that's a good start. I'm hearing something similar here in oil that, again, there's been a lot of issues on what I call economics 101, demand and supply. There's been a lot of very bad things done in the last few years. But to me, it sounds like, okay, we've got the economics in our favor. And the belief is, despite all of these, and I use this term loosely, green policies, we're going to need oil. Oil's not going to die anytime soon. And the chances are, because of economics 101, that price probably going to go much higher. Therefore, my base thesis for oil is that, and then I could go out and do some hunting and do some exploring about geopolitical risks. Does that sound about right, or am I completely off track here?
Yeah, no, that's pretty much correct. Like, the very high level view of it is there is a price to pay for underinvestment. And if you look at sort of conventional production oil, it's been largely in decline for a long time now. We got saved by the spike in shale. So to put it in context, like there was a point at which the world was really in trouble with the decline in conventional. And then in a very short period of time, we found the equivalent of two Saudis, one in oil and one in gas, in energy equivalency. And that appeared and was like a vertical spike. But the problem with the demand, which I went over, which is just quietly growing at sort of 1.5% a year, adding up, is that the shales, yes, they have a very steep sort of production ramp, but there's an equally steep sort of rollover on the back end of that. And with so much capital being thrown at it, like a lot of the shales were, I've got this great chart that shows how much they were throwing into sort of capex, and it was off for a long time there. It was from sort of 2000 and it was 14 to 15. It was they were doing like double what was free cash flow was going into capex. So it was just massive investment, and obviously drill baby drill, zero rates, and we don't have that scenario now, even though some people like to point to Argentina. So I did a piece on Argentina because I kind of found that fascinating. Argentina, if you just replicated drill baby drill, Argentina's probably better than what the US has. A lot of what's come out of those wells, if you were to set up the whole drill baby drill in Argentina, you would have a better, possibly a bigger outcome than in what happened with US shale. The thing is, so many people got burnt and got PTSD that Argentina's shale was just being done with cash flow from the local companies. Like, was kind of telling that even Exxon that had some acreage there, sold it back to local company and said no, they're going to actually focus in Guyana. Like, that doesn't add up. So it's going to be very incremental growth. It's going to be obviously policy there. Like, they still need the like Millet's doing a good job, but he's got to do it bit by bit, because any sort of socialist regime, the way they keep inflation under control is by capping energy prices. And so they still do have a certain amount of control on the energy markets, and they're not willing to remove it just yet. So he's doing it slowly, because he can't push it all at once, because it could backfire him if inflation really rips, and then he'll lose control of the whole support of the people. And yeah, I just see we've kind of taken that massive shale boom for granted. We just there's lots of forecasts that it's going to keep plugging the supply demand gap, and also there's this idea that renewables are going to we're transitioning. EVs are killing oil demand, renewables are like the whole green economy is taking off. I think anyone paying attention has seen that whole narrative is just face planted, especially with a lot of the sort of defunding now. Like, it's pretty clear a lot of these things could only survive with subsidies, and as those subsidies have been removed, and subtly in some ways, like China, which everyone points to as the biggest installer of solar and wind, they in April last year they removed. There was essentially a pricing system where wind and solar would receive the average of the coal index for pricing. They've removed that, so now they just get market pricing, and that's a really big deal with renewables, because once you add too much to the system, you can have deflation at a point. So solar is the obvious. If you add too much solar to a system, you get a point at the middle of the day where you've just got a saturation of too much energy coming on, and if you can't shift it, it essentially becomes worthless. It's solid deflation. And so they've essentially, by removing that the ability for solar power producers to get that market price, they're sort of saying, like, there's a point at which the economics are ceasing to make sense. And so all these projections for China just to build solar out into like just a massive ramp curve, and the same for wind, I think those are largely going to run into big headwinds unless they do use coal to balance a lot of the seasonality, and to use them as batteries in a way. And they have been doing some battery projects as well, but it's rather marginal. So yeah, sorry, another big a big ramble.
No, no, Fergus, it's okay. It's great to listen to. I think it's adding a lot of, number one, it's adding a lot of value, and number two, it's really putting a lot of things into context. Because I know that, all of us can overthink things, but I think this level of pragmatic thinking is incredibly useful, especially when you are then trying to make our lives better by investing. I think this level of thought is needed. So, no need to apologize, please. Uh, just want to finish off really on. I mean, I appreciate we could probably go for hours, but yeah, I'll leave it with one last area, which is the widow maker that is natural gas. And I know you've touched upon it very briefly when talking about oil. So similar question, really. What's going on in natural gas? What are you seeing, and what do you think that outlook is moving forward?
Yeah, so to start with, I've played it quite poorly recently. With I opted for coal, high quality coal over natural gas producers, and so natural gas has ripped lately because it was gonna, like my friend Paulo Macro, he's like, friends don't let friends trade the weather, and so I've been beaten up a few years with saying sort of if we get even a slightly cold winter, gas will rip and it'll drag coal up with it and we'll have a nice outcome. And for the last 2 winters, it was record warm and you got no love at all. And so we just got kind of just ass handed to me time after time, but it didn't do too badly because I just hung out in high quality thermal producers where I got a fat dividend, and when the thesis didn't play out, they just kind of essentially went sideways because they were so damn cheap. The likes of like Yarn Coal, I see it just announced a nice big fat dividend, and even though things haven't really worked, they're still doing fine. But yeah, I kind of missed it this year. With it was almost inevitable that at some point you were going to have a cold winter, and yeah, gas is ripped, and so anyone in gas producers is obviously having a good time. But yeah, it's just difficult. Like I don't really like, yeah, the weather angle just makes it so difficult. I still prefer the trend for coal. I think they're just so cheap. Granted, the stockpiles have been a bit high, and with all the LNG capacity coming on, and also Europe still, I think Germany still decommissioned another 5 gigawatts of coal last year. So that has taken a bit of the probably why that correlation's broken down a bit. But yeah, overall with gas, I'm constructive on it. I think granted, like, yeah, I'm not a short-term trader. That's the other thing. I don't really beat myself up if I miss like a short-term spike or anything. I'm more trying to like get in prior to the spike and position for where I see stuff really trending over time. And so yeah, I like gas, but I also see a lot of risks there as well. I kind of, the one I sent it out in one of my emails. I sent out like a sort of a weekly free email, and that question that I got asked a few times was like, love going into hated areas, and it doesn't seem to be like Europe's super hated at the moment. And is it at a point that it's so hated that there's actually going to be mean reversion? Like we seen sort of there's a sort of some sort of a peace resolution with Ukraine, could possibly Russian gas start flowing into Europe again, which would obviously be a massive hit to LNG, to sort of a lot of projections. Could Germany turn on the nuclear reactors again? I see that if like we're going to have a real, and it's always worth thinking about when you get too bearish on something. Often things can surprise you and flip around. I don't see it at the moment. I'm still bearish Europe, and I think they probably need more pain before things turn. But kind of I could see it pivoting. So yeah, for now, regarding the gas trade, I haven't got any direct gas exposure. I'm still in the thermal coal side. I think thermal coal is still the most unloved trade for the long term. With the likes of Europe reducing consumption, that's kind of something that is going to be more and more on the margin, because once they take their remaining sort of coal power plants off, it was never really a big part of the thesis. The thesis is that the developing world's going to keep relying on coal, and it's going to keep consuming it hand over fist. And this period of slow growth has resulted in stockpiles building up and some weak prices. So yeah, I see a lot of upside in the long term there, and I see oil having the best upside. And so yeah, I don't have any exposure to gas, which has been a bit painful the last 2 months. Yeah.
Fair enough. That's don't call it the Widowmaker for no reason. I think from my basic research I've done on it. So just to wrap up, obviously we've covered platinum, touched upon palladium, rhodium as well, looking at South Africa and discontent, shall we say, down there. I've also looked at oil, touched upon gas as well. Is there anything that we haven't covered that you would like to cover that you think is important that people need to know about?
There's always uranium, but I think everyone's kind of heard the uranium thesis. I think it's an interesting time here, because you've had like the key demand driver was always utilities coming to the table and contracting in size. And if you look at term contracting, call it 185 million pounds a year. In 2023, they contracted, what was it, 158, I believe. So sort of, was that where that is 2/3. And then last year, when we thought they were really going to come to the table, because they'd seen sort of a lot of the supply disruptions, they got a lot of the producers are missing and having issues, because they had problems, obviously having some big misses versus subsoil agreements, and yeah, to my surprise, I think most other people in the space, they utilities only contracted 105, so almost half of what they needed to. And to put this in context, in the last bull market, term like utilities contracted well over replacement rate, so they contracted up to 130, 140%, and that really is the central thesis for uranium. And it's kind of wild that we're 2025 and still haven't come in size. And then you kind of go on what everyone looks at, which is spot, and that market's essentially run dry. Just a handful of traders trading back and forward pretty small amounts, and playing games, and driven the price right down. Like there's no futures market to kind of keep them honest. It's just a handful of traders, and then you go out to the way you express it, and it fascinates me that they're all massively shorted. It's you can go across the whole sort of uranium producers market, all your names are actually producing meaningful pounds, and most of them have a short interest between 10 and 20%. And for me, it's a pile of petrol looking for a spark at some point. Like they're yeah. I hate the companies that you have to apply the view. I think they're all obviously constantly being a pain in the ass, but at the same time, I think when that those utilities start to come in size for the term, and spot will inevitably start to like jump up in a stair type fashion. I think the whole space, it's so small. Like it's always crazy when you look at like something like Farcoin and that getting, I don't know, I think when I looked at it, it had like a multiple hundred, I think it was like its market cap was in the hundreds of millions. And then you go across the uranium space, and this no, what was it? Dogecoin's a better one. That's 37 billion, and it's a joke coin, and everyone knows it's a joke coin. And that's larger than, or about the same size as larger than the entire uranium space. So yeah, once capital tries to get into this space, it's going to be interesting, but it's taken a long time, and it's been very frustrating. So with probably the one I'll touch on at the moment that I'm probably the trade that I like the most is Chinese tech, because it just everything I've talked about is, as I found out the hard way, it's all very correlated. If you've got a portfolio full of oil, uranium, and coal, when energy doesn't do well, you take it right,
Yeah.
get a punch square in the nose, and I got a very heavy punch in the nose, even though I loved everything I owned last year, and so I am a big bull on Chinese tech and tin. Actually, I'll throw tin in there because they kind of go to they're very uncorrelated to the energy trade, and so it's nice to have something that I think's got a great asymmetric risk reward. Great valuations. Like I kind of joked in the piece I wrote that, like if you pull up a whole lot of the Chinese tech companies, their valuations aren't too far off coal companies. Like they've got a third of their market cap in cash. Yeah, it's bottom crawling, breaking out, and then they just look like they've got a great growth runway when you consider how competitive they are and how I believe they'll dominate developing market demand. It's kind of funny where we're in a world where the Mag 7 is the valuations are kind of reflecting like they'll have global domination, because that's kind of what they need to grow into their valuations. Like if you're a multi-trillion-dollar market cap, you need a pretty big market to keep growing your revenues into. And so it's like the likes of the one I always point to, which is kind of, I think it's just nuts, is Tesla, when they're getting eaten alive in the Chinese market, which is 20% of their revenues, and BYD's like obviously just eating them alive, and yet they've got a 100 forward PE, and BYD's trading it 18 times forward PE, and yeah, that doesn't make sense to me, but that company hasn't made sense to me for a while. So yeah, I guess
I think there's going to be a lot of people that are going to be taking probably multiple punches to the nose. I was going to say noses, but then if you've got two noses, that's a bit strange. I think there's going to be a lot of people taking a few punches to the face, I think, in the next couple of years with US tech and large tech. I really do. It's bubbling away. I say bubbling away nicely. I use that term again loosely because not a lot of that makes sense to me. If I was getting involved in that, I'd be shorting that at some point. Not now, but that's not a financial recommendation to anyone listening. But that's what I would certainly be looking at on the major indices a bit further on down the line, because it has to correct at some point. There's a lot of data, a lot of history that would say that that's the case. All of that being said, I'll stop waffling. Ferg, I think that's been absolutely fantastic. I think we've covered a lot of ground there. I think it's a lot of food for thought for a lot of people as well. So thank you for taking time out of your day to have a chat and go through some ideas that you've got in your head. I always like to give people the opportunity to say a bit more about themselves and where people can find you. All of what you just are about to say, I will put links into the notes that come with this podcast as well. So if you are listening to the podcast and want to find all this, just go to contrariancapitalist.substack.com. I will put links to everywhere that you need me to put links to. So yeah, Ferg, how do people find you? How can people get in touch?
Just the Substack. Really, I don't use Twitter much anymore. So it's just Trader Ferg at substack.com, and I send out like a free email, which I just all the stuff I'm finding interesting. It's a article, podcast, quote, chart, and something I'm sort of pondering in the investment space mainly. I send that out every week, and then the rest of it's really just what I'm doing with my portfolio and how I'm trying to find an interesting angle to make money. It's always my I have a sort of a mentor that he runs a hedge fund, and yeah, whenever we talk and I kind of go too far down a rabbit hole, he's like, "That's interesting, Ferg, but how do I make money off that?" And I feel that that's one of the great things for kind of keeping me grounded, is like you can always get too caught up in sort of macro waffle, but like how do you express a view on that, and then let me sort of follow the track record of that idea over time, which is yeah, I think that's what keeps the most honest, is are you actually making money, or are you just trying to sound smart?
Yeah, fair, fair. I'm going to make a mental note of that myself. I like that. Yeah, traderferg.substack.com. Again, I'll put links into the notes that go with this podcast as well. Again, if you're watching this on YouTube, yeah, the links will be in the description as well. Ferg, again, thank you very much for your time. I look forward to, if it's you okay with it, maybe let's catch up a bit later on in the year and get the lay of the land then.
Certainly. No, I'd love to, Robert.